Start recorded.
Okay. Hi, everyone. Thanks so much for joining us for today's accounting design project workshop. My name is Kendall Lynch. I'm an assistant professor at the University of Washington. I'll be the moderator for the workshop. We're happy to have Mark Ma from the University of Pittsburgh presenting his paper, Operating Lease Recognition and Credit Assessment by Banks. Before we start, I just want to remind everyone of some house rules. In the first 5 minutes, please let Mark present with no interruptions. And then after that, if you have questions or comments, please raise your hand in the Zoom or put your questions in the chat and I'll call on you and I'll call your name in order of the question. In the interim, please mute your microphone. So if you're not speaking, there's no unnecessary background noise. And also turn your camera on to allow Mark and I to see your lovely faces. Without further ado, let's welcome Mark. Mark, the floor is yours.
Oh, thank you. Thank you for the introduction. It's nice to know that I have 5 minutes without interruption. I thought it start questions will start from the beginning. So I'll finish my presentation in 5 minutes. I'm just kidding. So it's a great pleasure to be here, to be connected with you over the internet. This is so nice to also present our paper about operating lease recognition and credit assessment by banks. So this is joint work with Holly, Ben, and Chen Qi. I'm not sure whether Ben is here. Oh, Ben is here. Yes, he told me he will be here. So he answers all the tough questions today. And so I know that usually people say the thank you slide, have the thank you slide at the end, but really today I really want to say a big thank you to Ayang and Stephen, because I think this is so nice. And I believe that it's critical for accounting research to address relevant issues that firms, regulators, and the public really cares about. How to do that? We could several ways to do that, right? So we could help corporations make better policies, and we can help investors make better investment decisions. Also, we could help standard setters better understand consequence of rules and standards, right? I believe the purpose of this seminar series is to help accounting standards and regulators better understand the rules and the standards. And I think that's really important. Just in case, I'm not sure whether there are PhD students here, but if there are PhD students here, I have some suggestions, because these are the suggestions I share to my PhD students in my PhD seminar, that in addition to reading articles in top accounting, finance, economics, management journals, I suggest you to also read business news, read practitioner journal articles, go through the accounting standards. I mean, print out the whole document. Like I remember, like a decade ago, I printed out all the whole document of SFAS 131, which is the segment reporting standard, which is more than 100 pages. And I read through it, and I found so much like interesting information in it, and it helped my research. And also read the comment letters when there are new standards. There are a lot of information in it. So our research question is, how does the implementation of new lease standard ASC A42 affects banks' credit assessment? So to show that our research question is still relevant, or this standard ASC A42 is still relevant. I checked the Google Trends this morning. And here is the Google Trend data from over the last 5 years. And actually, the Google Trend reached the peak exactly 2 years ago, October 22nd, 2022. So after that, it starts to decline a little bit, but there are still a lot of discussions about ASC A42. So this is still a relevant topic. A little background, I'm pretty sure most of you already know this, but just in case someone is not familiar with it. So the legacy standard SFAS 13, which was issued in 1976, it requires these lessees to classify leases into 2 groups, capital lease or operating lease. And it uses several criteria to do for the classification. For example, one of the criteria is lease terms exceeding 75% of the assets useful life should be classified as capital lease. So that means if the lease term is 74.999%, it's operating lease. Otherwise, it's capital lease, right? So there's a big difference, even though a small percentage change in the lease term. And the standard require lessees to recognize capital lease on the balance sheet, while operating lease were not recognized on the balance sheet. And there are early research which shows that after this standard, firms switch from capital lease to operating lease and the other non-lease source of financing. And this market for operating lease started to bloom. And in 2016, there's a IASB report which estimates that the total amount of off-balance sheet financing through operating lease by U.S. public firms exceeded $2.8 trillion. To put this number in a context, like everyone talks about AI nowadays, the AI market is expected to reach a value of 1.8 trillion by 2030. So this market for operating lease was much bigger than the AI market. So the big operating lease market caused a lot of concerns in regulators, because there are many regulators concerned that the reason why these firms are using operating lease is just to avoid recognizing these liabilities on the balance sheet. So for financial reporting purpose. Therefore, from 2009, the FASB, and IASB started a joint project. They discussed about how to recognize all these leases on the balance sheet. And in October 2010, they released their first exposure draft, collected comments. And in May 2013, they issued an updated draft. And in the updated draft, they provided exception for short-term lease, shorter than 1 year. And finally, in February 2016, FASB issued the Accounting Standards Update 2016-02, ASU 02, which is the official standard, and it will become effective for fiscal years starting after December 15, 2018. For public firms, but for private firms, there is a different starting date. So what exactly are in these standards? So according to this new standard, these are still classified into two parts: finance lease and operating lease. The finance lease is still essentially similar to capital lease, and the operating lease now are largely required to recognize on the balance sheet as ROU, a right of use assets and the right of use liabilities. The exception is for those operating lease shorter than 12 months. And in this standard setting process, there a lot of people expressed very strong oppositions. Actually, I think the proposal received more than 1,400 comment letters, and most of them are negative. And for example, this letter from American Banker Association, it says that the incremental benefits of changing the standard is in the end questionable. So a lot of oppositions from these practitioners and from the banks. And actually, after the standard is being released, there are still a lot of complaints about the new standard. So FASB recently said that they want to have more academic research about this to better understand the consequence of this standard. So why do we focus on banks' credit assessment? So first of all, in a lot of those comment letters, they talk about the consequence on bank loans. And if, for example, in this comment letter by the American Bankers Association, it says that credit officers and banking institutions probably make up the largest group of users of financial statement that will be affected by the exposure draft. And also, there are a lot of concerns about the potential negative impact on firms' debt financing capacity. For example, if you look at this CNBC article, it says a big change in accounting will put $3 trillion in liabilities on corporate balance sheets. It's really interesting that this title only talks about liabilities, but at the same time, we also actually put $3 trillion of assets on the balance sheet.
Mark, we have a question
yes.
from Peter. Go ahead, Peter.
Sure.
Thanks, Kendall. You can hear me?
Yes.
All right, great. Thanks for bringing this topic here. It's really an interesting one. Question I would like to ask in terms of, it's kind of about this first box you have up here, which is credit officers and banking institutions make up the largest group of users of financial statements. Which I agree, they're definitely users of financial statements. My question is, how, and I don't know if this is kind of clear from the comment letter, but I'd love to get your take on this, which is how do you view lenders as using the financial statements? Because I view this kind of as two different things. One is there's using the financial statements to collect information to kind of set up the loan in the first place. So kind of an ex-ante kind of screening, right? But then there's also the use of financial statement information to monitor the loan on an ongoing basis. And I have my own views on exactly how the information, how this would change the information for using those. I'm curious kind of what your perspective on that is.
So not a banking expert. But this is definitely something interesting. And yes, first, when they make the loan decision, definitely they consider the firm's financial conditions, right, based on this financial information. And then after that, they have these covenants which try to continuously monitor the firm's behavior to avoid kind of risk moral hazard. So initially they have some adverse selection concerns, and after the approval of the loan, they will have more moral hazard concerns, and they will have these covenants based on financial information to constrain certain like risk-seeking behavior by the manager, right? So I think the most of the concerns here in the discussion related to the lease accounting is a lot of firms or practitioners are saying the application of the new standard will change the financial ratios. As a result, they will violate the covenants. And whether that's true or not, that's another, there is another study which shows that actually a lot of companies in their bank loans, they actually have frozen accounting provisions. That means when there is new accounting standard which change the concept, like in our setting, change the concept of total assets or total liabilities or total debt, actually you still continue to use the old concept to measure or old measurement to calculate those ratios. And therefore, my understanding here is the concern is about the existing loans rather than the new loan approvals. Does that answer your question?
Yeah, I mean, I didn't get to read your paper carefully. I just got to kind of scan the introduction. So I just jumped on it a little late, but the flavor in the paper is a little bit more about kind of perceived credit risk, which feels like screening to me, like the information is kind of feeding into the loan. I am not convinced that this really changed screening all that much. So I agree with you that I think monitoring is the place where this is going to be kind of most relevant. But the way that works, I don't think of that as credit risk exactly. That's more just kind of compliance role of the information. But I'll let you go on ahead and keep laying this out.
Yes, that's something. Well, we will think about that. Thank you for the comments. And actually, if you look at this other comment letter by the National Association of Realtors, it says that the new lease accounting proposal reduced the overall borrowing capacity. I think here they are actually talking about the capacity to borrow new loans, right? To get new loan approvals. And I guess, like, I mean, this National Association of Realtors, they are not happy that firms are.
I mean,
reducing
they
their
have an incentive to say this, right? So I think
Yes.
that's nonsense because it's not like lenders were not paying attention to off-balance sheet stuff before this. So them saying it lowers borrowing capacity, unless firms were very, very cagey about actually really truly concealing their off-balance sheet, which I don't think they'd be able to do systematically. This is purely incentive driven based on what they want to do, I suspect.
Yes, of course, yeah, of course. And these realtors must hate me a lot because I have two papers. One is about operating lease, shows firms reduce their use of operating lease after the new lease standard. I have another paper about return to office, which attracts a lot of attention, which shows that firms are not financial performance are not improving after return to office. So these empty offices in the downtown area, the people will be not coming back. But anyway, so yes, they are incentive. Their incentive are behind these comments. Their economic incentives are behind these comments. Yes. Yes, and also contrary to these concerns, banks and creditor rating agencies routinely adjust off-balance sheet financing behavior already in their risk assessment before the lease standard, right? And also most loan contracts already have frozen gap provisions. And in my earlier study with my doctoral advisor, we actually found the issuance of the new standard improved credit rating during the transition period. We didn't look at how the impact of the implementation. We look at the impact of the issuance. And in this study, in the current study, we try to look at the impact of the implementation of the new standard. And in addition to direct recognition of operating lease on the balance sheet, the accounting standard also require lessees to provide additional quantitative and qualitative information to enable financial statement user to assess the amount, timing, and uncertainty of cash flows from lease. So just some examples. Qualitative disclosures may include information like certain assumptions firms use in the calculation of operating lease liabilities. And the quantitative information could include the weighted average remaining lease terms and also the weighted average discount rates. So just trying to show you a concrete example. So I look at the United Airlines recent 10K. If you look at this paragraph here, it says that for leases with terms greater than 12 months, we record the related right of use asset liability and the present value of fixed lease payment over the lease term. And to the extent lease agreement include an extension option that is reasonable certain to be exercised. We have recognized those amounts as part of our right of use assets and the liability. All right, so I think previous to this standard, we will now know how they deal with these with potential extension options. And also it says that we recognize lease expense for those leases on a straight line basis over the term of the lease, right? So that's a straight line base. And previous to the lease standard, we also do not know this.
Mark,
Yes.
you've got another question.
Yes.
Sorry, it's me again. Related to this standard was very much about making this, providing this information in the financial statements. One of the things that's kind of key about private loan market is that lenders are privy to information directly from the borrower. My sense is that this is the kind of information that the borrower would have and probably the lender would be asking for. And this is a little bit what I was getting at before, which is I think maybe the lenders had this information even prior to this standard, even though it wasn't related publicly. But my guess is things like the various details on the lease contracts, whether there's an option, whether it's likely to be exercised, and so forth. I don't know if you have a sense about this, whether this information would have been available before, or if this is actually providing new information.
Well, we do not know like the exact answer to that, but that's a really interesting question, and we actually thought about that because according to my limited understanding of the literature on bank loans, so there are syndicated loans with many lenders in the same loan, and in this case, like there would be a lot of free riding issue. So maybe for those loans, the banks still do not understand the details of these information, right? So actually, I think we have information. We did some tests, probably not in the current draft, but previously we have some tests to show that in those large syndicated loans with many lenders, actually the results are stronger. So yes, that's something we definitely want to talk probably in the next draft. Yes, well, our paper is currently under revision. We are revising it, and we welcome any comments. We will try to incorporate them. Yes, thank you.
Mark, we have another question.
Yes,
I don't
please.
have a question, but I try to kind of like help Mark to address Peter's point. So we kind of like the paper I presented a year ago, like we reviewed about 7,000 loan contracts. There's about a quarter of the contracts already specify that the liability includes off-balance sheet leases. So if the lender already consider off-balance sheet leases in their liability definition when they set up the financial covenants. I would assume that they can request that information. Otherwise, how do they know the borrower at this period already exceeding that limit or threshold or not? Yeah. It just, yeah.
Thank you. We will cite your paper. Yes. So that's an example of the qualitative loans and qualitative information. And also, in addition to that, there are also more quantitative information, like the weighted average remaining lease terms, and also the weighted average discount rates, right? So before the standard, we can only guess about these terms or this information. And we make even banks, a lot of them make some kind of assumptions about this, right? So now we know exactly these numbers are. So therefore, maybe it's plausible that the ASC 842, instead of hurting firms' financing capacity, they will lower the perceived credit risk of affected firms by providing more information and reducing the uncertainty about their operating needs behavior. So therefore, we have these nice predictions. So on one hand, a lot of practitioners, as they stated in the comment letters, they think that this new standard will hurt their financing capacity, debt financing capacity. However, on the other hand, research shows that banks are already adjusting this based on the information they have in the footnotes prior to this standard. If so, maybe there is no effect, or maybe if this additional disclosure reduce uncertainty, and also if the recognition of these operating lease assets and liabilities reduce firms' opportunistic use of operating lease for like over-investment, maybe that would be actually a positive impact. So there is a lot of attention here, based on my understanding, what's the direction will be. Even though I agree that the National Association of Realtors, like they are motivated by the economic incentives, but they are making such claims really loud. I think it's really still important to show that they may be wrong, right? Yes, Kendall, yes.
Yeah, I'll call it myself. I have a question that's, I think, sort of on the theme of what Peter's been asking so far is, for the prediction where this would reduce uncertainty, what do you think it is about this information that would reduce uncertainty for the banks? Because as Peter's been saying, this is information that they could have requested. Is it the mere act of like figuring out what our discount rates would be and providing that information? Like, what is it about this information that actually reduces uncertainty for the banks themselves?
Yes, that's really good question. And we can think more about that, how exactly it reduces uncertainty. That's a really good question, I think. Prior to, as I said, if there's a large syndicated loan, maybe there is some kind of pre-rider issue, and not every bank will spend efforts on collecting the information or verifying the information. And now this information are provided to them, and the cost is much lower. So maybe that will help them reduce their uncertainty they face, right? So, but that's a really good question. We could definitely have more discussions about exactly what information reduce uncertainty the banks face. Yes. Yeah, just in case Ben and Chen-Qi, both of them are here, if my answers are not good enough, please step in. So I feel there is a lot of tension ex-ante to examine this research question, right? So what we did is mainly Ben. Ben has this magic to obtain this proprietary data. That was proprietary at that time, but maybe it's become publicly available now at a very high expense, right? So, but Ben got this very interesting data about credit ratings from credit benchmark, and what they did is they asked information about banks' assessed probability of default, and collect such information from different banks about different customers, and then calculate a consensus across the different banks' ratings. And I think the rating ranges from 1 to 21, and 1 means really low risk, and 21 means really high risk. And I really like this data set because this is a continuous measurement of, continuous update of the bank's risk assessment. So compared to traditional measures like loan spreads, which are infrequently updated, only updated when banks apply for new loans, this measure actually is updated every month. And also, it's a direct and comprehensive measure of banks' perceived credit risk. Like if we measure credit risk based on loan spreads, of course, for firms with higher risk, loan spread is expected to be higher. But in addition to loan spreads, banks could put other constraints in the loan contracts, like more restrictive covenants, right? So for firms with higher risk, maybe they will have more restricted covenants. Therefore, loan spread is definitely one very important aspect of banks' credit risk assessment, but that's not really a very comprehensive measure.
Mark, we have another question.
Yes, Ayan, please.
Mark, so for those 40 banks, do you know that whether those banks has lending money or lending facilities with your sample firm? So are those 40 banks are existing lenders or potential future lenders?
I think they are existing lenders. I could be wrong. Ben probably knows this better, but I believe they are existing lenders. Not all of the 40, but like only existing lenders have credit risk assessment of their clients. So they collect, maybe a firm has loans from 5 banks, so they collect the information from these 5 banks and calculate a consensus from these five banks. That's my understanding.
So do you see the list?
If I'm wrong,
do you
please
see the
correct
list
me,
of these 40 banks? Like, do they disclose to you that who are those 40 banks?
I do not know.
Okay.
Ben probably knows it better. It's a proprietary. And at that time, when we started when we started the project, this was a proprietary data set. And I thought it's a magic to get this proprietary data set. And Ben probably knows that better. Please correct me, Ben, if I'm wrong. Yes.
Okay. Ben just told us that there's no disclosure of the banks. Okay. The reason I asked this question is that the first 30 minutes of a discussion between you and Peter, we were actually assuming that those are the lenders. But I think without knowing whether those 40 banks actually are existing lenders, those are potentially future lenders, but they have to probably rely on financial statements because they don't have a private channel to collect that information, right? So you think about that this standard may not benefit existing lenders who are already able to request their borrowers to provide off-balance sheet information, but for future potential lenders, those are the externalities that actually impact them, right? So I think there potentially an opportunity to distinguish whether those are existing lenders versus non-existing lenders, because the information set that what Kendall hinted on is actually quite different. And then the impact of this standard across those two groups of lenders, banks can be different, but you have to live with the limitation of the data.
That's really interesting. That's a really interesting point, and we definitely will consider that. I think what we have in the data set is the consensus, not even the individual banks rating. And we have data about a number of banks who gave these assessments, right? Number of banks included in the calculation of the consensus, but we do not even have the name of the banks. But maybe Ben could get some additional data. We can do some further analysis. Yes.
Sorry,
Yes.
and
So
then consensus is an average, or
yes, that's the average. Yes, no, it's not the average. It's like analyst recommendation, right? Analyst recommendation, consensus recommendation. That's the most common most common reading. Yeah, that's my understanding. Otherwise, I think it's all the rankings are integers, right? So otherwise, that could be like 7.5, 7.6, right? So I think that's the most common, the mode reading. And also using this credit rating data, I think another big advantage is that we could avoid issues about firms self-selection to apply for bank loans, right? So if we look at loan spread, it's only available for those banks that applied for bank loans and gets approved. So there are actually at least two selection issues here. But for this, using this data, we could like to some extent mitigate this to a very large extent, I would say, mitigate this selection issue. So this is our regression model. So the dependent variable again is the bank rating, which range from 1 to 21. 1 means lowest risk, 21 means highest risk. And the indicator post is for observations of firms in the post implementation period. And we have a series of controls and two-way fixed effects for this model. And also we have a short event test window of 24 months centered surrounding the adoption months for each firm. Yes, I am.
So are you concerned COVID-19 is your confounding event?
That's a very good comment. Well, I do not know exactly what we can do about that, but at least we should add a caveat in the paper, right? So maybe March 2020, right? We do not have much observations adopted in that month or after that month, but we could definitely check whether results are robust if we exclude samples after March 2020. Yes.
So when you on your slide you say it's a generalized difference in differences. So what's the second layer of difference here in your design, other than pre-post?
So because there different firms adopt this actually implement or adopt this standard at different times, and that's what I will explain in the next slide. So there is actually exogenous variation in the timing of adoption. That's because the new lease accounting standard became effective for fiscal years beginning after December 15, 2018. So depending on when the firm fiscal year ending day or month is, they will adopt it and in different fiscal years. And what's important is these fiscal year ending months are predetermined a long time ago. Most of them are predetermined a long time ago before the lease standard. Right, so therefore we believe there is some exogenous variation in the timing of the adoption. Just two examples. So Ashland Global Holdings, ticker ASH, fiscal year ending date, fiscal year ending month is September, and ASH adopted this standard in the fiscal year of 2020, starting October 2019 and ending September 2020. So it reported the capitalized operating lease for the first time in the fiscal quarter from October 2019 to December 2019. In contrast, United Airlines has a calendar fiscal year ending date. So for United Airlines, it adopted the standard in the fiscal year of 2019, starting January 2019, ending December 2019. Sorry, not 2020, 2019. So it reported capitalized the operating lease information in the first quarter of 2019. So there is a time. There is variation in the timing of the adoption. That's where our variance comes from. Does that answer your question?
Yeah. I think a related question is like, I think your simple firm is about 618, right? And then about 252, you say those are the non-December fiscal end. And then we kind of like usually retailers, right? Retail firms are actually heavily affected by this standard, right? You can see from the comment letter too. And many of them have non-December fiscal year end. So I'm just curious why there's such a high percentage of your sample firm that are non-December end, and then how does that generalize to the rest of the 3,000 listed firms in the US market?
I think that's probably because the bank reading data is not available for every firm, right? So that's probably why. Yes, that's the distribution of the adoption months or adoption time, right? So yes, we do not have many calendar fiscal years, and but there are a lot of variations across different months. That's a good comment, and we could compare our samples fiscal year ending months with a more comprehensive, maybe the CompuStat universe, right? So that's we definitely want to do that.
Do you know what industries these are in?
Sorry, I think we talked about that, but now it's I don't have the answer for you right away. But I think we did look at that. One could add we could add the information about industries distribution.
I think related to that, given that there are like 1,000 plus common letters, I believe that different industry associations may have a different opinion, right? And that opportunity for you to actually partition your sample based on the ex-ante common letters, like whether it's a for or against, and then your exposed validation using the post-implementation data, right? Yeah.
Yes, that's a really good comment.
Their common letter is going to be self-fulfilling depending on how sensitive their business to this new standard, right? So
exactly, yes.
Retailers were heavily affected because most of them are off balance sheet, and then that's why they're against it. Yeah.
Yes. CVS is not happy.
And then even beyond that, like firms like GE Capital didn't want this to happen because when they were offering leases and financing, they were saying this is a great benefit as it's off balance sheet. So even from like the provision of leases to like the supply side.
Yes, these are very good comments, and we will definitely incorporate them in the next draft. Yes. Thank you. All right, so this is how we got our exogenous variation. And one more thing I want to talk about our research design is our measurement of firm size. So ASC A42 significantly changed the definition of total assets, right? Because we added all these operating leases onto the balance sheet. Actually, firms' total assets become no longer comparable before and after the standard. And a lot of ratios like return to assets also are not comparable anymore if you use just the information reported on the face of the financial statements. Therefore, research using sample periods, including years before and after the standard, should be very cautious about how they define firm assets and what scalar to use. And therefore, we actually, instead of measuring firm size using total assets, we measure firm size using total sales. And also we use total sales as the scalars instead of total assets in tests when we need to do such scaling. And this is consistent with my prior paper with Wen. So here are the main results. The coefficient on this post indicator shows the change in the bank rating after the implementation of ASC A42. Yes, Kendall.
It's weird to call on myself. So I guess this is where I want to reiterate my own question. So even if you weren't getting private information, we do it in our intermediate accounting classes. We can capitalize operating leases. We can estimate some sort of discount rate and we can capitalize operating leases. Is this precipitous drop in bank rating, like, are they not incorporating that capitalization of operating leases? Like, here's where I'm interested in, like, what is actually the mechanism? What is the information being provided here that results in such a drop in the bank rating?
So I think what we did, not in the current draft available, publicly available, but what we did is we look at, like, we try to estimate right of use assets using the information previously available before the standard. And actually there is an estimation error, very big estimation error to some firms. I think there is another working paper by a professor at Columbia. I do not know the name of the paper, sorry. But that paper also shows that there is a big variation in how accurate you could estimate these right of use assets based on information prior to the standard. I think one source of such estimation error is the discount rate. Like prior to the standard, you can only like use certain kind of bank loan interest rates or other interest rates to approximate the discount rate. But after that, firms are actually disclosing their discount rates, right? So this information will be more accurate for a lot of
So
firms.
I have one comment on that, and then Peter has a question or a comment maybe. So when I was implementing this at companies, they were using their own like debt facilities to figure out what their discount rates were. So some of this is public information that if you put in effort, you could figure out. So what it seems like is that these banks were not putting in that effort, although they could.
I think if my memory is accurate, when I read the standard, it says that the discount rate could be a marginal borrowing rate, right? So that will be, you can find that from the loan, or it could be the specific interest rate specified in the lease agreement.
Right,
So
which is very rare. That latter one is very rare. It's usually the incremental borrowing rate that firms are using.
Yes. That's I agree because I try to collect information about the actual discount rate in the lease agreement to see whether actually accounting information could actually affect that actual rate in the lease agreement. But most of them use marginal borrowing rate. Yes, that's right. Yes, and
go ahead, Peter. Sorry.
Yes.
My comment builds, I think, on what you've been saying, Kendall. And so I have a conjecture of something totally different that might be happening here, because I'm skeptical that there's really information being revealed to lenders by this standard. I think that information is there. I think Kendall's been saying that in a similar way. We know that this standard changed behavior, and we know that typically leasing standards do change behavior. We know that leases are structured based on avoiding or working into a certain treatment. So you get this way. And I think there's even a paper about ASC 842 where there was more loans that went under 12 months, so they didn't have to do this or something like that. The way I interpret it, or an alternative interpretation that I think is worth exploring, is that the old lease standard induced suboptimal leasing behavior because you're structuring leases in ways to get a certain treatment. This took away that treatment, specifically the operating lease treatment that kept things off the balance sheet. Therefore, what we're seeing here is a rationalization where firms are now forced to do the better thing, do the more optimal thing, and hence they're actually going to be seen as less risky for that basis. It fits the results ultimately, and I think that's kind of the key thing. So I think it's definitely a kind of real effects story here might be driving what you're seeing.
Yeah, and there is a paper, Christensen et al. I can't remember who the other co-authors. I think it's Lynch is one of them, not me though, where they talk about the operational efficiencies that were gained through implementing ASC 842. So along like that fits Peter's real effects story as well. So we've got a question from Joshua and then Christina.
So my question is simple. It looks to me like what you should do is split your sample into 2, maybe 4 parts, and do it based upon how close were you if you estimated the operating leases impact using the prior disclosure to the actual disclosure in the following year. So if there are no
Yes.
if there are no differences, then you don't expect the standard to have any effect on the bank ranking.
Yes, that's a very good suggestion, and I think we try something. It's not incorporated in the paper yet, in the current draft yet, but definitely we will do that. We will do that in the next revision. Yes, that's a very good suggestion. Thank you. And there's one more question.
Go ahead, Christina.
Yeah, hi. So when I was working in a bank, long time ago, one thing we were doing is forecasting cash flows. So it was all about cash flows and whether, we get our payment back. I mean, that was the big question. I'm just putting that very simplistically. So I understand that it's an accounting, accounting standard change. There's no cash flow implications per se. But one thing I'm trying to my students when, we are doing that with IFRS 16, in the UK, it's very similar, not exactly, but it's very similar. Then if you really see the cash flow from operations, previously, before we capitalize, we do these things with operating leases, we had to really account for the lease, cost us, as a cash outflow. So it was a big amount there. Now, we just have interest paid now. Okay, so there is a big difference in the calculation of cash flows. So we have, an increase in operating cash flows and decrease in cash flow from financing. So, it's all really canceling out and there is no really cash flow effect. But here is my question, whether, this kind of cash flows effects are driving some perceptions. I don't know. Yeah, maybe. I don't know.
Yes. So yes, so where there could be some real effect, cash flow effects, definitely. And we consider that in the paper, and it's not problem. Maybe can you? I can talk about it on the next slide. I'll just go through, make sure that I go through some important information on this slide. Right. So the coefficients on the post indicator is significant and negative in both specifications. And this is consistent with lower bank risk assessment. Lower banks perceive the risk after the implementation of ASC A42. And if you look at this figure on the screen, the change actually happens fairly quickly, right after the new implementation of the standard. Also, we do not find a pre-existing trend or downward trends before the implementation of the standard. So to understand the mechanisms for this, we definitely considered both information effect and also a potential real effect, right? So our main results show that the implementation of ASC A42 reduced banks' perceived risk, and we expect such results to be stronger if the firm has more pre-period rating dispersion. That means there is more disagreement among the different banks, because in addition to the consensus, we also know the dispersion of different banks' ratings. Also, probably firms with more pre-period abnormal lease, they will also get a bigger benefit from the lease, because all the prior research suggests that these firms have this abnormal leasing behavior. Abnormal is predicted by the economic incentive, like the lease can generate a tax benefit, can generate operational benefits, but after controlling for all these determinants based on economic factors, some firms still have more leads compared to others, and prior research suggests that these are the leads that the managers are trying to use to overinvest and to try to do some rent seeking using these leads. And we predict that firms with more abnormal operating needs in the pre-period could actually see a bigger decline in the risk assessment. That's because the new lease recognition probably will constrain their opportunistic usage of operating lease after the implementation. If so, there could be some real benefits, right? So that's the second prediction for the cross-sectional variation. And the third one is we look at exactly how much disclosure the firm has about operating lease in their financial statements after the implementation, and we count the number of pieces of information related to operating lease in the 10K, and in the quarterly report, and then we think if a firm disclose more information, probably they will benefit more because that could help reduce the uncertainty faced by information users. But of course, we need to think more about exactly how it works and do a better job explaining what happens there. Yes,
I have another question. Yeah.
Yes.
Mark, I feel like your middle graph, which is pre-post interacting with pre-period abnormal operating leases, probably is a tighter empirical design. At least in this setting, you do have a different diff with treatment and control firms depending on their pre-reg implementation operating lease levels. My question is not about that. I have heard about it that there are different type of the tangible assets. Some will be more likely to be leased, some others are more likely to be purchased. Do you know anything about that, about real estate assets versus equipment, machines? Somehow there's a cluster of different, the nature of the assets.
Yes, definitely.
Or on the balance sheet, off balance sheet.
Yes, definitely. There are studies about switching between capex and using lease, and one big reason is using lease give you more strategic flexibility. Like you do not need to buy. At the end, you do not need to sell. So if that equipment is outdated, like you don't need to actually sell the old equipment in order to buy a new equipment, right? So you just need to end the contract, and that's one big reason. And for certain type of assets, yes, it's like for certain type of assets, like they get more frequently updated, right? So these like airplanes, maybe they will have new models every like 5 years or 6 years. So those yes, they need to lease them because otherwise, who will these airlines sell to, right? So, but for some other things like real estate, yes, real estate probably, I mean, they do not get updated. So like they do not have a lot of innovation in that space. So probably those assets they will more likely to buy. But a lot of real estate are leased. Yes, yes. I think we could further consider the type of assets, right? That's your suggestion, right? So what's the type of the assets the firm is leasing, right? So whether it's something critical to the business, or whether there's something that the firm should have more lease rather than buy, right? So the type of assets and again, that's closely related to your prior comments about the industry. And that's something we definitely want to consider. Yes. Well, so should I move on? So all the 3 predictions are supported in our tests. So basically, we found results consistent with both real effect and also the information effect. But clearly, we want to better discuss about exactly what happens for that information effect. So we did a number of different robustness tests. We did a stacked regression, difference in difference regression. We used the ordered probability model. We use a longer event window, and also we exclude firms that reduced operating lease in the post period to make sure that it's not just the real effect. And we dropped early adopters because firms do, some firms do choose to voluntarily adopt this standard earlier than the deadline. And also we try to adjust some financial ratios in the pre-period, and we did a placebo test by moving the events to 1 year earlier than the actual implementation date, and we do not find results in that placebo test. So I have 5 minutes. So it's great to receive all these comments. So in this paper, we found banks' internal bank ratings improve after a firm adopts the new lease standard, and the results are stronger for firms facing greater uncertainty prior to the implementation, with more abnormal operating needs in the pre-period, and also more operating needs related information disclosed in their quarterly reports after the implementation. So the implications of our standard of our funding to standard setting, based on my understanding, is the new operating needs, instead of hurting firms' bad debt financing capacity, it actually benefits these firms, and it also supports FASB's initiative to increase transparency related to these, and also it clearly also would support the IASB's initiative. And there is another question.
Yeah, we have a question from Joshua.
It's not a question, it's a comment. Another way to split your sample is not necessarily by the type of assets, but by the length of period over which the leases extend. I know the information was not available earlier, but you could get a sense of that if you look at the interest expense that they report on the income statement versus what would be the next year's expense if you looked at the operating lease. And that is something that I've used before, and it gives you an indication, because the whole idea here is you need to capitalize leases only if the leases are going to be in effect. So if you look at a company like H&R Block, they have a lot of leases, but the leases are only a 1-year lease, as compared to because they get the offices for one tax period, and then the next tax period they could move a few blocks away, and it doesn't bother them. Whereas if you look at airlines, that's a big thing. So, and the two industries that are most affected, the question came before, I think, are airlines and real estate and retailers.
Yes, and actually, after the standard firms are starting to disclose the average remaining lease term, and we could think about this along the line you suggested, and also we could try to use firm self-disclosed data about remaining lease terms, and that's definitely something we want to consider. Yes.
Yeah, you can also estimate it, as I said.
Yes.
For the standard.
Yes.
I'm going to call on myself again. I think Ayang alluded to this, but that first bullet point for your implications, I think, needs to be caveated a little bit, because you don't know from this data, right, if these are their clients. We don't.
They are their clients. It's well, I do not know exactly who are the banks. I cannot say 100%. I need to verify that. Yes.
Yeah. So yeah, just that caveat if necessary. Go ahead, Ayang.
Yeah, I feel like not just the caveat, like whether you are able to conclude that, because if you think about on a macroeconomic level, right, if you are talking to FASB or any standard setters, it seems like accounting standards somehow create this welfare effect by reducing the perceived risk that we don't know what actually happened. But does that mean that we should have more of that kind of the new standards bringing more assets or whatever liability to the balance sheet to make the economy more vibrant? It's just like, I feel before we actually really know what's going on, I think I would hesitate on concluding because that will actually have a very ambitious policy implication when we are not sure what actually is driving the results. Yeah.
Yes, we will think about all these, and that makes sense. Yes. And so I have 1 minute left. So finally, I have some good news to you. There will be a better presenter next month. So Miao Liu from Boston College will present on November 5th about his paper, very interesting paper about narrative risk disclosure and how it affects asset price. And I will try to attend. I hope you will also be there. And finally, thank you again, Ayaan, for organizing this, and thanks to Kendall also to help moderating this. And I appreciate all the